So you traveled around the world with a backpack twice. I would love to hear about this. Uh, how did it start? Where'd you come up with the idea and tell us about your journeys?
I got my undergraduate from Tulane University in New Orleans, and I studied political science. And I used to keep a map of the world on my wall. And one of my roommates and I would always joke around, like, okay, after we're done with college, we're going to go here, we're going to go here, we're going to go here. And then I graduated college in 91, and it was a bit of a recession period. So there weren't that many jobs. I took that opportunity to move home, live with my parents who lived in Connecticut, and I got a job in New York City. And so that roommate of mine and I decided, why don't we just live at home, save up as much money as we can for a year, and then go backpacking? So we literally did that. We worked for a year, doing jobs in wherever we were, and and then in October the following year, we headed over to Nepal and started trekking in Nepal as our first stop. But we went from Nepal. We spent 3 months in India. We hung around all of Southeast Asia, headed over to the Middle East. It was pretty amazing. Came back in time to start graduate school, got my MBA, and I'll fast forward through the work and all that stuff. But I started a company. I sold that company. But while I was growing that business, I kept on saying to my friends, as soon as I sell this company, I'm putting on a backpack again and I'm going around the world. And wasn't married. I didn't have kids at the time. But I did it again. We sold the company, and I would say a month later, I headed down to South America. I went to Antarctica. I had more money this time, so I went on the safari in Africa. I built my own safari over 6 weeks, and I went to Scandinavia. I just went everywhere, and all the places I hadn't been before. Yeah, it was pretty cool. I got my MBA in international business, so that international bug has always been there.
That helped a little bit then. That's great. That's what I went to college for as well. That's awesome.
What's your favorite city and what's your favorite, let's say, nature that you've seen? Very curious.
Easily, my favorite city is Rio de Janeiro. Brazil is just fascinating country. What I love most about Brazilians is their love for family. So when you're in Brazil, and you're like, it's a big city like Rio is. So there's apartments like New York City. There's apartments everywhere, and you can see into everyone's window. But what you see is very different from what you see in other parts of the world or even here. You see grandmothers dancing with teenagers, and the teenagers are home. Like, they're all there hanging out with the family because that's just what you do. And so they like to have fun. They like to do things together. And, it just taught me so much. Not to mention, if you haven't been to Brazil and you go to the beaches there, I don't know many places in the world, and I've been to quite a few of them. But Brazil is one of those places where you go to the beach and there's mountains that surround you. And to be on a beach and be surrounded by mountains is such a cool experience, that I just really loved. So not necessarily the best food, but culturally loved it. And it's just beautiful place, and it's cheap.
Yeah, that's great. That's amazing. And obviously through that whole process, I don't know when you wrote a children's book as well, right? Or a book that,
Right.
yeah.
So fast forward to having children. So I got married. I had two kids, but when we were living in Miami Beach, and again, this is one of these things where, like, it's been great. I moved to Miami from DC after we wrote the legislation and passed the crowdfunding law. And it was like living in paradise. I was just like, I can't believe you can live in this place in the United States that seems like you're on vacation all the time. But then when you live there, you realize this is not a place to raise a family because everybody's on vacation all the time. And it's just a very party atmosphere, which is great when you're single. But, as soon as you settle down, you're like, I need to get out of here. So we, chose and moved to Denver. But my first son and I, I'm sure all parents do this, where you just read in bed every night and we tell stories. And when Max was 3, he said, we should write a book. And I was like, well, what do you want to write about? And because I always talk about how he charges my love battery. And he's like, well, let's write a book about the love battery. And the whole theme is our hearts are a battery. and it's charged with love. And you get that love by interacting with our friends and our family and our children and holding and hugging and kissing and loving them. And over the course of the day, the battery drains down. And that's why at night you need to cuddle each other. So we wrote that children's book called The Love Battery. And right now it's being illustrated. And I'm going to publish that, as well as Crowdfunomics, which is the other book that I just finished writing, which is a completely different type of book, but the economics of crowdfunding.
I love it. That's amazing. That's really cool. That's awesome.
Thank
Well,
you.
that's great.
Very cool.
Yeah.
So you've done it all, Woody. Traveled the world. You wrote children books. You sold companies. Why don't you tell us a little bit about your background? So talk to us a little bit about the companies you sold, and just walk us up to today where you're at with the crowdfunding.
Okay. So I got my career really started after my MBA, and I started on the trading floor for Payne Weber, UBS now. And then I went to the retail side of that in California and decided I just wasn't into investment banking. So I left to go work for a Silicon Valley startup called PeopleSoft at the time, which grew to be a very large company, private equity, venture funded private equity, sold to Oracle, pretty bad merger. But learned everything about starting, scaling, funding businesses just by watching what they were doing at PeopleSoft and how they treated their employees. I then started a healthcare technology company with my brother-in-law called FlavorX, and we flavored medicines for children so they're more compliant. So if you go into a pharmacy, it's like going in an ice cream store and you get to choose whatever flavor you want your medicine to come in. And we grew that from one pharmacy to 40,000. We were venture capital finance. We were a 3-time Inc. 500 company, EY Entrepreneur of the Year. And we sold that to a private equity group in 2007 because I went through a Sarbanes-Oxley audit, because we were planning on bringing the company public. And we were a small company, but had big aspirations. And during the audit, the auditors were like, well, how do you receive a check from China? And I was like, I don't know. We don't do business in China. And they're like, well, we need to actually write all this out. And I was like, this is a complete waste of time and money. So I told the board of directors, we can either, sell the company, but I'm out. I'm like done. And so that's when we sold the company. And then I just went on a rampage that Washington, D.C. and Congress don't know what they're doing when they create legislation that does not scale down to small businesses. I was based in D.C. at the time because that's where FlavorX was. And so I was asked to testify in front of Congress. That was the first time I did. At a hearing on the negative impacts of Sarbanes-Oxley on small business, and I just railed on Congress. I didn't know any better. Like I literally showed up and was like, "You people have no idea what's going on. I literally could have created thousands of jobs, but you think this one size fits all." And they carved out an exemption for small businesses 18 months later. So that was like the FlavorX whole thing. But after I sold FlavorX, I was always irritated with the fact that when I was raising money for FlavorX, I would get calls from parents like, "Oh my God, I got my kid to take, his or her medicine. And this, what you did is amazing. Like, how do I invest in your company?" And I was like, "Listen, if you're not rich, I can't take your money. But I'm keeping a list because I don't know, someday maybe you will." And I only raised money from accredited investors, venture capital. And I always thought it was stupid. Like, why are we missed opportunity? Like hundreds, thousands of customers that could be brand advocates for FlavorX. I was just like, if I got them as investors, and then they have, this vested interest in the outcome of the business, I just go to them and be like, "Okay, ladies and gentlemen, this is the marketing I need you to do." And because they have a vested interest in the outcome of the business, my theory is they'll just go out and do it for me. And at the time, there was this company called Buzz Marketing or something, and it was based on that whole concept of viral marketing through community. I don't think they went anywhere at the time, but it stuck with me about that buzz marketing stuff. And so I sat down with 3 friends of mine after I sold Flavor, after I got back from the part of the world travel the second time. And I said, someone needs to do something about this. I mean, it's just ridiculous that we live under these laws that were written 80 years ago. And so Jason, Zach, and I all had been venture funded. And I said, why don't we look at this Reg D exemption that we've all raised money under and literally rewrite it as if we were merging the principles of Kickstarter and Indiegogo with early stage venture capital financing. And so we came up with an 8 bullet point framework. We had a roundtable in Sand Hill Road where we talked to all our VC friends and asked them, like, at what point will we be stepping on your shoes or your toes? And they're like, don't do 5 million, 1 million. We're not going to say anything. So we got sort of buy-in from them. And then we went to the SEC and presented them with this framework. And they said, it's cute. There's a building with a white dome over there. And naively enough, we just went over to the Capitol and just started walking the halls of Congress, knocking on doors, asking to speak to people who are in charge of jobs. And the people, the staffers were fascinated. It didn't matter if they were Republican or Democrat. They're like, are you lobbyists? Are you lawyers? And we're like, no, we're just three entrepreneurs that, are trying to help create jobs. And this was in 2008. Well, this is in 2010. So we'd gone through the 2008 recession and DC was looking for jobs. So everybody was meeting with us. And so we had the first hearing called in the House Financial Services Committee by Patrick McHenry, who was really the chief champion for investment crowdfunding. The White House had someone at that hearing, and the White House called after that hearing. I did what you're supposed to do, which is promptly hang up on the White House because I thought it was a crank call from one of my friends. They did graciously call back Doug Rand, and he's like, no, honestly, I'm calling from the White House. And I was like, why? And he's like, we had someone at your hearing. We think what you're doing is interesting. We'd like a 2-page write-up. So I gave the White House 2-page write-up, and they sat on it for 2 months, but then got back to me saying, we want to get behind what you guys are doing. I let Patrick McHenry know, and he's like, well, if Obama's, the White House is in favor of this, Democrat, we're the ones that took the horn by the reins, or the horse by the reins initially. Let's just push this through. So we took it, put it through committee, crafted a bill, put it through committee, got it to the floor. It passed 407-17. And then we testified in front of 5 House and Senate panel hearings on both sides. Senate, and so then we crafted the compromise bill in the Senate. There were 3 competing bills there. We learned everything we needed to know about Washington. Like, it's great when you go there not knowing things because you can just do whatever. And so we're like, what are we going to do with these 3 competing bills in the Senate? And I was talking to my father about it. He's like, just write the compromise and present it to all of them. They're not going to know any difference. And I was just like, really? And he's like, just try it. And so we literally took the 3 bills and we're like, what is the intent? What are they? And there were 2 Democrats and 1 Republican bill. And we're like, what's the intent? And we merged the best of what we thought was all of them, which is the final version of regulation crowdfunding that was signed into law in the Jobs Act by Obama. And we went to all of their offices and said this was the compromise. Now, the beauty about it is because nobody talks to each other, even in the same party in Washington, they were able to buy into the fact that this was the compromise. Now, I'll tell you a funny anecdote about all of this, which is why you shouldn't let 3 entrepreneurs show up in Washington and create a law. So the night before that it went to the floor of the Senate to be voted on, someone from the Senate Banking Committee called and said, can I just talk to you guys about the bill? And so we're like, yeah, sure. So we go in there and he's like, okay, first off, who's the law firm that you worked with? And so Jason, Zach, and I sort of looked at each other and looked at him and said, were we supposed to work with a law firm? And he's like, you're kidding me, right? And we're like, no. And he's just like, this bill is going to be voted on in the Senate tomorrow. I can't stop it. Like, it is being voted on. And you're telling me there's not one law firm that looked at any of this. And I looked at him and went, that's correct. And so in the bill that passed, there was an error. It was supposed to, if you know anything about the structure of the law, investors can invest based on their income or net worth. But it was supposed to be the greater of either of those 2. So, you can invest up to, 10% of your income or net worth, whichever is greater. But we had lesser in there. I don't remember why. Maybe it was, maybe in the compromise, we put lesser, but we meant to have greater. And so when the law came out, everyone was just like, oh, well, that doesn't work for people that don't work, but have a ton of savings. They should be able to invest more. So we had to fix that later on, but I have thousands of these stories from where the bill happened, but that's the backstory.
Very cool. So, all right, so you got this bill over the edge, and what happens from there?
So we left the White House, and then we were interviewed on Bloomberg Television immediately. They wanted to know, what is this thing that just happened? What does this mean for startups and small businesses? And afterwards, the reporter said to me, he's like, what role are you guys going to play? And I said, well, we can't be a portal because we promised the people when we were lobbying that we weren't doing this for our own self-interest. We're which is another funny story because the first time that came up when someone said, "Are you guys going to start one of these funding portals?" I said, "Well, yeah, why? I mean, why not?" And they're like, "We're not going to get behind this if it's for your own self-interest." And I literally looked at them and I was just like, "But isn't that how Washington works?" And they're like, "You cannot say that to our face." And I was just like, "Okay, understood." Like, so I have so many of those stories of how we did everything wrong. But we kept our word. We're like, okay, we won't start one of these funding platforms. This is just the right thing to do. It'll be great for startups and small businesses. So that fast forward to the reporter, and he's just like, Woody, you had that career at PeopleSoft, databases. We at Bloomberg buy data. Why don't you build a database that aggregates information on all the companies that are raising money online? And when the data set gets big enough, that's the type of data that we will ingest and resell. So I built that database, went live the day the industry went live on May 16, 2016. And we've been collecting 125 data points on every single company that's raising money online. What's the coolest thing about the data set, and there's a lot, and as you can see, I'm very excited about this whole thing, is it's not just what you would find on PitchBook or Crunchbase or in Edgar filings. We collect all the Edgar filing stuff, but we then enrich the data based on what you have in the offering documents. So it's sort of performing that layer of diligence or research that you find venture capital doing. And so we go into the documents, we pull out the valuations. We actually want to know, are you women or minority founders? Things that you're not going to find in typical documents. And so we bring that into the data set to enrich it, look at the industry and all that stuff. And then we just started tracking something that no one else has, which is investor sentiment. So if you look at PitchBook or Crunchbase, it's looking at a very static period in time, how much was raised in a round of financing. What makes us different in the data set is, and this is true only for regulation crowdfunding, not for Reg D offerings, not really for all Reg A offerings, obviously not for 506 offerings unless it's done online through a portal, but for all Reg CF offerings, they have to happen online. So every day, because it happens online, we can capture the number of checks that are written and the total amount that's been deployed into these open offerings. And right now there's over 600 on a daily basis. So you can see the volume of that is both fascinating, but the depth in which we can understand where capital is going is really telling, because we can see now when you triangulate industry, daily capital flows, what's hot, what's cooling, which valuations are trending up or going down in different sectors and geography. And so, the data set's just grown tremendously since it started. In 2016, there were 20 companies when it started. Right now, we've got 8,500 offerings that we've covered. There's over 7,300 companies. Every month, there's about 140 new companies that come into the data set. So you can just see how it's growing exponentially over time. And that's why our research has just grown in this whole area as well.
That's pretty exciting. Yeah, it's interesting, kind of just how that progression happened from where you started, right? So I guess maybe catch us up to where things are at today and kind of what you're focused on and kind of what's happening with the crowdfunding space.
Okay. So crowdfunding has evolved from even what we thought it was going to be. When we were walking the halls of Congress, there were two constituents that I thought would benefit most from this. Startups, mainly in the software space that were not in Silicon Valley, but, spread like Omaha or here in Denver, that had a great brain trust coming out of universities, but just didn't have access to venture capital, but had a good community and a network of people that would fund them. And the other one that I thought were Main Street businesses where remember the whole peer-to-peer, world and how that really blossomed. I saw the P2B business as being a potentially huge part of this, particularly for those companies that were less than 3 years old that don't qualify for bank financing. Fast forward to today. So, like I said, 8,500 offerings in every state, 1,400 cities where this has been funded, 450 different NAICS codes. So NAICS is an industry classification system. We also group things by subsector. But if you just go into those NAICS codes, you've got healthcare and biotech, you've got EV technology. I mean, it goes far beyond what I ever thought it would be. Clean tech is out there. And so the beginning stages of these companies, they need smaller amount of capital to achieve smaller goals. And that's really where this is fitting in. It's It's filled the funding void, that valley of death that existed from 25,000 to 250,000. But because the amount that these issuers can raise can go up to 5 million now, we can provide a lot more capital to help them get to that next level. And the types of companies and the SEC, so the SEC changed the cap that you could raise from 1 million to 5 million in 2021. That fundamentally changed the type of companies, the issuers coming in, because there were no longer these startups. In the beginning, 65% of the data set was companies that were less than 3 years old and were pre-revenue. Now, 65% of the data set is over 3 years old and have revenues over $1 million. So just in 7 years, it's just flipped in terms of the type of issuers coming into the marketplace. And that's what makes this data set even that much more fascinating, because we were able to take the data and look at it from how do we identify promising investment opportunities. And so, we look at Crowdfund Capital Advisors as sitting at the convergence of three themes. One is data, one is venture, and one is liquidity. And that's the key, what we see are the key things in the private capital markets. The data, of course, tells us everything that's happening in these companies. Venture capital is necessary to help these companies scale and grow. Even after you graduate out of crowdfunding, venture plays a very important role. And then liquidity, who wants to be tied up in these investments over time? So that's the key other part. And so we've been working on that within the data set to look for companies that we think are really smart ones to invest in and get in at an early stage and a lower valuation.
This is very cool. So tell us more about CCA. Tell us about you mentioned like the sentiment data. Like, what kind of who's using this data at the end of the day? Is this like VCs? Is this individuals? Like larger shops? Like, tell us about kind of who uses the data and kind of what they use it for.
Okay. I'll answer the CCA question part, and then I'll go into the data part. So Crowdfund Capital Advisors came out of, the bill, the legislation. We helped form the industry association that sort of oversees the entire industry. And then we started working with the World Bank and the State Department. We wrote the World Bank crowdfunding's potential for the developing world because the World Bank reached out to us and said, what you guys have done for entrepreneurs here in the United States is great, but entrepreneurs really in developing countries could truly benefit from this. And you put a regulatory structure around it, which is what people need, investors, particularly for that trust factor, to know that their investments are going to be used for what the company needs instead of going to someone's pocket. And so with that World Bank report, we then went with the State Department and the World Bank to 43 countries around the world. So you could think of that as maybe my third trip around the world, but this time it was paid for by them, where we went and helped prop up crowdfunding ecosystems from Chile and Mexico to we spent a year in Saudi Arabia, if you can believe it, going back and forth, helping get up their ecosystem. We've worked all over Asia, Malaysia, and Thailand. So it's been fascinating from that perspective to see the global movement of crowdfunding. And that's really what the book that I just finished writing, Crowdfunomics, is based on. I've just taken everything that we published, everything that we've thought of in terms of the economics of crowdfunding, the benefit of crowdfunding, the job creation, how people can get wealthy through it. And it's in this brain trust of a book that hopefully will be out at the beginning of the summer. And that's like CCA. So data, advisory, consulting there. The data itself is just a whole fascinating machine. It's, to your question, who's it useful for? I see like three different areas. One, you've got entrepreneurs. Okay, entrepreneurs want to know what makes this a winning campaign. So within the data, you can actually, we've got this C-Clear Navigator. C-Clear is our data sister company. And the Navigator allows you to go in there and sort and filter for any company in the ecosystem. So you could see what companies do I look like that, and, where my revenues might be the same, and you can compare valuations. So it's a great tool to help you come up with comps for your company when you're going out doing a round of financing. It also helps you figure out, well, a company in a different part of the country raised this amount from this many investors. That can sort of help you understand the type of capital you can raise. For investors, venture capital, private equity, family offices, it's great because it allows them to have insight into what's happening either in industries or in regions of the country, particularly family offices are very focused on creating jobs and entrepreneurship in their own little regions. And so this enables them to look at the data and help set a baseline for where the things stand in their ecosystem and help promote entrepreneurship and innovation through crowdfunding education, and then track the progress of that over time. So I see that as well. And then for, government officials, I see this as a phenomenal tool because the data doesn't talk about, entrepreneurship, which is a great thing. And I think we all love, but it talks about where's money going and how money's being used. And when you look at the fact that you've got these companies like, in 1,400 cities, what I love to talk about with government officials is look at the P&L. These companies are spending money in these communities. So the more that we can fund and invest and scale these companies in these local communities, and for the most part, they don't get up and leave when they get big. They stay where their home is. This is just going to mean more money pumping into your local economy, more jobs. It's going to be, people buying more houses. I mean, it's going to blossom. And so right now in the data set, I can tell you that there's $6.8 billion being distributed in local communities around the United States because of these companies that are funded successfully. So I like to point out that to them. I like to point out the job creation because everybody likes to talk about jobs and we track the number of jobs. I like to talk about, investors getting rich. So that's something, when you look at venture capital investing, and I'm sure you guys talk about this a lot, you have to have like the long tail. Like you're not going to get rich quick. You got to sit on it for a while. And that's usually 7 to 10 years for VCs. Industry started in 2016. We're 7 years into it right now. We're starting to see these IPOs. So IPOs are happening within the data set. So what does that mean? Those investors that got in at the earliest stage are now getting rich. So depending on how much you put in will determine how much you're going to get out. But we're just starting to see the seeds of that. And I think as this industry is going to pop when a couple things happen. One, when the media in general starts to cover these success stories and these average Americans that got rich off of trusting and investing in someone that they knew with a small idea, but also when institutional capital gets into the space. And that's an area where I'm really focused right now. We took the data and we sat down with 3 PhDs and we said, this data can tell you a lot about companies that are raising money all across the country. And I was like, I've had my own exit. I can see what I think are traits of successful entrepreneurs. I want to build an algorithm that can look for signals in the data set to predict which companies are likely to go on for a follow-on round of financing. Not who's going to, IPO, because that's impossible to guess. But if we can sort of look for those signals and then wrap a venture fund around this algorithm, we can now invest in these companies after doing, a layer of diligence that, an algorithm will pick up to look for the companies that will hopefully graduate from the data set and go on to do bigger, better things. And with the goal being, if we can invest in 200 companies, $25,000 a pop, or this first fund was $5 million or is $5 million. Then we can prove to institutional capital that there's a way to segue into investing in these small businesses. Because right now, Morgan Stanley, JP Morgan, they have no way to figure out how to deploy $100 million into the space. But if you put $100 million into a fund that's driven by an algorithm that looks for these signals, and we can prove this through experience, then hopefully we can get that in. That will allow the pop to happen that I think the industry needs. So
Yeah, that's pretty fascinating. Obviously, having the data to really kind of drill down in at a granular level and take a look at what's happening. I'm curious, Woody, with just like macroeconomic factors like inflation or federal policy, how does that influence crowdfunding activity and the current state of where we're at today?
it was fascinating. COVID, I thought, was going to really decimate the industry. And it had the opposite effect. What happened is businesses needed capital. Banks, everybody was struggling to find it. People were at home in front of their computers. And all of these local community investors came up to support all of these businesses saying, I don't want you to go out of business. You're a vital part of our community. And so, believe it or not, in 2020, 2021, that was the peak. I think this year will be the next peak, but that was the peak of investments that we saw. So things like that have benefited. The supply chain where we saw that, the whole supply chain problem that we had with the industry, that, however, caused a problem. So when Silicon Valley Bank collapsed, when venture capital decided, you know what, we're going to sit on the sidelines and now we got trillions of dollars only being, put into companies in their own portfolios, we saw a drop in the industry. So we saw a drop in the amount of deals that are happening because issuers are thinking, I need to time this market. It's not the right time for me to go out and raise capital. But again, the opposite thing happened, which is investors were still putting more money in. So we saw a jump in the average check size happening over time. So the macroeconomics plays in a fascinating way that doesn't always makes sense. Like, I understand the drop off in the number of deals. Not quite sure why that led to more capital coming in, but we've seen more capital flow in. I tell you, the area where investors are really benefiting right now is where interest rates have gone up. So in that P2B side of crowdfunding, the debt side, the revenue share, mainly the debt side, where you've got simple debt, companies are going out and borrowing money from the crowd at 11 or 12%, which you might think is crazy for a business to do. But if you can't get capital elsewhere, and this is a way for you to get that capital and get it from your customers, they're doing it. And so the default rate on these loans is incredibly low. And so if you're an investor in these deals, you're earning this phenomenal return on investment for terms that are typically 36 months. And so it's turning out to be a great area for investors that decide to back these deals because, again, default rate low, high interest rate, which means a higher return for them.
Yeah, that's really interesting.
Yeah, very cool. A couple different directions I want to take this, but I want to start with in terms of the setting up crowdfunding. So let's just say I have a company, I'm selling pictures, and I want to be able to raise some capital here. Do I need to form a legal? I mean, obviously, an LLC, but like, how do I go about actually getting the capital from people that want to invest in me? And could I take capital from anybody? Is there maybe a limit amount of people? You know,
The So first, you have to be a U.S. corporation in order to do this. That being said, we do see foreign issuers coming in, establishing, domiciling here in the United States and raising money from U.S. investors, not with so much success as local companies. But you have to incorporate as a local business. And then depending on how much money you raise, you either can self-certify the numbers that you present to investors from your financials. But if you're going to raise over $124,000, I think was the cutoff, you need to have CPA reviewed financials. So there's got to be someone else that looks at your numbers, and it's not a full audit, but I've been through one of these, and I'm surprised at the depth of detail that the CPA people go through in terms of asking questions and verifying both the receipts, the checks written, and all that stuff. So for the venture fund side of our arm, we actually don't even look at deals unless they've raised over $124,000 because we want to know that there's been that third party that's looked over the numbers. So you need to incorporate it as a U.S. entity, depending on how much you want to raise. You might have to have accountants in there. The beauty about what this whole industry is we've taken something that was piecemeal, that was sort of hard to do. You had to pull all the pieces together, and we've systematized it. And so if you go to platforms like Start Engine or WeFund or Republic, it's like TurboTax. You're like filling out a form and you're completing information about your offering. You will have to have offering documents that go along with it, but there's services like LawCloud. I think their name now is iDisclose, but you can literally go in there and they'll help you create the entire offering document. So you don't have to know so much anymore about putting this stuff together because the technology has stepped in to facilitate it. And so you put the offering documents together. I think the companies that put a video together are the ones that do best. I would tell you right off the bat, make sure you tell people in that video what you need money for, how you're going to use it, and what you hope to give them back. Because people that just talk about what it is without explaining why they need them in there, I don't see those companies doing as well as the other ones. And so you have to put that video together, and then this takes time. I tell people, you're not going to get this done in a few weeks. It probably takes 3 months, and it takes a team to put it all together. And then you launch it, and then you got another full-time job, which is marketing it. So you need to get out there and engage your entire community, which hopefully you've built beforehand. And then you have to get them to listen to what you're doing and then engage in what you're doing and then get their money. So there's a lot of work that goes into these offerings, and they're usually open for, I would say, 90 to 180 days. So if you're thinking, is this right for me? Go in with your eyes wide open. I would tell you, look at data sets like ours, so you could see what you can expect to raise in a certain industry, what your valuation should be. I'll tell you right off the bat right now, don't put one of these crazy valuations out there. We looked at a beverage deal recently with $115 million valuation on $1.5 million in revenue. And I was just like, what are you doing? Like, how do you justify that? And
That's big multiple.
the thing that makes crowdfunding, I think, so great, but also so risky, is the fact that anyone can ask a question. And if you can't defend your answer, everyone's going to read it and they're not going to invest in you. And that's the logic that you see in these offerings. Like, people that put that up there, people are like, you want crack? Like, who puts $115 million valuation on a $1.5 million revenue? And so, deals like that die. So you
Yeah.
need to research, you need to understand that you have to be within a ballpark in order to raise capital. But if you're selling pictures, search in the data set for, picture sellers and see who's got something close to you, and scope,
Yeah.
your offering around that.
Yeah.
Kind of trend is in terms of like actually getting capital from these investors. Do they need to be accredited investors? Is there a limit to how many investors you could have?
So when we wrote this law, we wanted both retail and accredited investors to be able to participate. But we knew that the government would have a big issue with the average Joe being able to invest money. And so for the first time, we decided we would restrict what the average Joe could invest, provided that, with this law becomes effective. And that's where we put the caps and limits on what they could invest. And it's about 10% of what your income is or your net worth is, whichever's greater. And so anyone can invest in this. Accredited investors really can invest as much as they want because they're accredited. What we're seeing in a lot of these deals are parallel offerings, where you've got the 506c side of a deal happening and a regulation crowdfunding side. So the Reg CF side is mainly retail investors. The 506c side is accredited investors that have no caps and limits on what they can invest. And so, companies are raising money from all of these, anyone that really looks like them, I would say. And I think that's a key thing. Because we track women and minority founders in the data set, whenever, we do these monthly reports where we do an industry deep dive, and I love to interview the entrepreneurs. And I always ask them, can you tell me about your investor base? How, what relationship do they have to you? Yeah. How do they look? And it's a very funny question. How do they look? But I'm trying to get at, who are they? And the answer mainly comes down to, these are people I know, and they're people that are in my community. So women hang out with women. Minorities tend to run in minority communities. Just by default, we all hang out and stay with people that we're familiar with, that we share a common bond with. And so I think that's a key part of it, is the investor base really looks like the investors.
Yeah, that's really interesting. So you mentioned that in the crowdfunding space, the max you can raise in these types of structures is 5 million. Is that currently right? Or on an annual basis? Is that right?
On an annual basis. And right now I'm trying to push Washington to up that 20.
Right. Okay. That's very interesting.
Yeah.
And these platforms that are out there, they charge a kind of a fee structure based on assets raised, something like that.
Okay. Yes. So you will pay probably around 7% to raise the capital. Mm-hmm. So it's not cheap. If you're a big company, you go to a broker dealer, typically 2 to 3%, but you're also raising, hundreds of millions.
Right.
of dollars. These are smaller offerings, so the fees tend to be higher, and you have to budget for the cost of putting these offerings together. We did a research paper a few years ago on the cost of putting these offerings together, and what we found is it was about 5.6% of the total amount raised. So you need to budget for that plus a success fee. So it'll cost a little.
Yeah. It's
Yeah.
interesting. You mentioned the parallel funds, and I find it coming from the fund operation side of the equation, my background. I find that technology is very much behind the times, shall we say, in the institutional space, whereas the retail is really kind of into the forefront. To your point, crowdfunding is very much an online endeavor. Do you see kind of changes in that progression of technology kind of moving forward with more of the kind of accredited, qualified institutional space as there, because that seems to be been the challenge for a lot of these platforms out there trying to entertain the institutional market.
Yeah, I feel like a lot of the technology that's been built for investment crowdfunding is going to find its way into the institutional marketplace. So cap table management and, shareholder voting, all of these shareholder communication, investor relations tools. There's all these cool little things that are built for crowdfunding. So you get how to pull the people together and then use that to get a message out to them and then tell them what to do. I think is, going to go to, larger institutional side of things too. I think, that type of stuff exists, but I think they're perfecting it in this side of the marketplace.
Right. Makes sense.
In terms of the crowdfunding, so if somebody was to, purchase these shares, is there a liquid market where, maybe I could resell some of my shares, or, is it kind of just waiting around like a private equity investment for, uh, you know, maybe either buyout or IPO, things like that?
Right now, most companies, most investors have to sit and wait for an exit from their business. What's changed and part of what happened with the Jobs Act is the potential for liquidity. And so what that means is there's a 12-month holding period on these securities in regulation crowdfunding. In Reg A, there's immediate liquidity. You can sell the securities once they're bought. But it all depends on the marketplace. Like, is there enough demand for these securities on a secondary market? So the third product that we built is called Guard. And Guard is a fintech company that helps private companies do the ongoing filing and disclosures that they need to do so investors are informed about how a company is performing. And this information is published in with a regulated entity called a National Securities Manual. And and it's known as the manual exemption. And it states, because securities that want to be traded in a secondary market, believe it or not, I know this sounds crazy, but we didn't account for this. It's regulated at the state level, not at the federal level. The beauty about crowdfunding at the federal level is you don't have to deal with 50 different states' rules. But when it comes to secondary trading, it's not at the federal level unless it is on a national exchange. So you have to register your securities in all 50 states or all the states where you want to offer and sell them. And it creates this bottleneck, and it's why the secondary market hasn't blossomed. But what we realized is with this manual exemption that states if you publish information into a national securities manual, you can then qualify so you don't have to register in all these states, essentially across the board in all 50 states, with the exception of New York and California, so that you can have a market for secondary trading these securities. And that's where we're headed. So with Guard, if you publish your information through Guard and we publish it into the National Securities Manual, we give you a report that then goes to an alternative trading system whereby you can say, I want to list my securities on this exchange. Here's information, current information, which is the hardest thing to get on private companies, about the company itself. So investors have the most recent information, and then the secondary market will develop. Now, we thought it would be much more advanced than it is right now. I think we're in, inning 2 of secondary trading. I think it'll be much bigger later on. We've got this supply of companies that have come into the marketplace through Reg A, through, Reg CF, through 506C, provided that the securities are exempt, unregistered, and unrestricted. And what this will do is when the demand now builds up for these securities, we're going to see the activity take place in the secondary markets. And so that's where I think a lot of this industry is headed. It's the next frontier. But I think, there's going to be a lot of great opportunity there. For Guard itself right now, all of our business is really in Reg A offerings with series LLC issuers like Masterworks that are, taking a piece of Picasso, breaking it up into 100 pieces, selling it to investors, and investors can either wait for the Picasso to appreciate in value and then they sell it all off and investors get that, or someone can buy it. It'll appreciate over time because it's marked to paper, and they can get out if someone else wants in. So there's a whole secondary market for collectibles, for artwork. I mean, it's pretty amazing what we've seen develop there.
Yeah, that's interesting. Obviously, what you were talking about earlier was the blue sky rules, right? For each state that can bypass that process, which is great, potentially there. Is there any restrictions on what you can invest in? Any asset class, like asset agnostic in a Reg CF?
No, and that is a brilliant question. So we've all seen what happened with NFTs, ICO, security token.
That's kind of where I'm going. Yep.
Yeah. So of course the SEC is not qualifying any token offerings, nor do they want to.
Right.
We've seen the whole issue that's come up with blockchain, Ethereum. When we were pushing the legislation through and when the SEC was working on the rules related to this, we really thought they were going to limit the type of security to simple debt and common equity, period. They did not say anything about the type of security. And so what this means is you can legally issue tokens, and we've seen this happen through crowdfunding. You have to wait 1 year. So it's the 1 year holding period. But after that 1 year holding period, you now have tokens that can trade on any exchange. So what I've been telling NFT issuers, what I've been telling these token issuers is, file right now. Just get an offering together and raise some money through that offering. And then you can split the tokens and whatever you want after that 12-month period, holding period's up. But you can have freely transferable tokens that are through a regulated process for which the SEC can't stop it. I mean, I guess they could, but they created this loophole and this passageway. I think, no one has yet to take up on that. The other thing I said is if you don't want to wait, I can give you a list of, all these token issuers that did do exactly that, I haven't seen them do anything with it. Why don't you just acquire them and merge your securities together? And then you can have freely transferable tokens, Bitcoin, Ethereum. Hello, any of you guys, if you're listening, this is, yeah. Cause,
Right. That's what I was thinking about. Yeah. Just to be clear, it's Regulation CF and Regulation A, both?
No, Regulation CF only.
Okay. So Regulation A is different than Regulation CF. Okay. Got it.
Because the Regulation A offering, the SEC is going to see that you've got tokens listed.
Right.
And then they're going to have all these questions.
Right.
In Reg CF, it's an exemption from qualification or registration. So it's a form filing. So you're filing it with the commission. It's going into Edgar, but there's no restrictions on the type of securities that can be issued.
Yeah. Thanks for clarifying that. That's good for the audience there to know.
Yeah. People want to, talk about how to get that done, and I can easily guide you on that. I've written about it multiple times. I did a whole piece on why NFT issuers won't get to where they need to be, and how they could do it. And by the way, let's just talk about that for a second. Look at how long ago was security tokens? 3 years now, or the ICOs. Like, if you just did it 3 years ago, you'd be the big fish out there right now. There's no time like today to get started. But everyone's fighting the SEC. Like, let's just fight the SEC. And I'm like, there's probably easier ways to do this.
Yeah. Under the legal laws that are in the books. Right.
Yeah.
Interesting.
Curious about trends. What do you guys, you have so much data, what type of trends you guys seeing right now? Is there, particular sectors that are really hot, or, geographies that you're seeing more activity, kind of, what are some of the major trends that are standing out to you these days?
I was surprised to see that California leads in everything. Because I just thought, because we democratize access to capital, the rest of the country is going to benefit. But nope, it's where the people are. It's where all these businesses are. It's where capital is. It's mimics what happens in the public markets in terms of investors and dollars. They come predominantly from California, New York, Texas. And in the data set, it literally shows the same thing. The number of the capitals from California, New York, Texas, Florida. The issuers, California, New York, Texas, Florida. There's just more people there. So those trends, I didn't know it was going to be that way, but it's playing out that way. The thing that I find fascinating is just the diversity of companies that are raising money. This one company, Boxable, I don't know if you heard of them, but they do prefab like casitas, or that's how they started. And now they can do workforce housing. And so, you literally go on your computer, you can create the specs for what you want and they'll ship it out to you. It's pretty cool. So they started their crowdfunding journey online through Reg CF at a $42 million valuation. Now way into Reg A offerings, raising hundreds of millions, government contracts. I think here in Colorado, they're building workforce housing up in the mountains by the ski resorts. Just a huge list of people buying their products. Their latest valuation was 3.2 or $3.3 billion. So if you put, $25,000 into that at the first round, it's worth well over $2 million right now. We're seeing that type of story play out over and over in the data set. Boxable is, I think they're in Las Vegas, which is another fascinating thing. We took the data and I said to my team, I was just like, let's start a crowdfunding genome. And let's take all the data and let's create these genomes around, metropolitan areas in the country where we're seeing a lot of crowdfunding activity. And we're about to release that whole Tableau dashboard and report itself. But what we're finding is it's not Silicon Valley. And we collect all the data from companies that are raising money in Silicon Valley through Reg CF. Las Vegas is number one on the list. Phoenix is right behind them. Austin, which you would think would be high on the list too, and they were 3 years ago, is number 3. So that's the type of thing that I find is fascinating is look at what's happening in Vegas, look at what's happening in Phoenix and track what's happening there and the type of companies that are using it. The biotech issuers. I mean, for the venture fund, one of the companies that we just looked at recently was this automatic arm that would pick strawberries, but it was tied in with this vision technology that looks for the strawberries, can identify which are the ripe ones, and can then pick it. And this is usually done by a human. And of course, you're limited to the windows of sunlight to sunset, but they don't even go that long. It's usually a 9-hour day. This machine can go 24 hours a day up and down the fields and leave the ones that aren't ripe yet. And so it increases output. It increases productivity. It reduces costs. It was just fascinating to see. And then there's the technology side of all this is just blowing my mind because the drone stuff that we see, we spoke to this company where the CEO was just like, the government put out an RFP years ago saying, we need to have a drone that can take off and land on a moving object. Not take off from the ground, but objects moving, we need it to take off from that and we need it to come back to it. And so this guy, former military, and these people are brilliant that are putting these companies together. He's like, so I had a background in electrical engineering or whatnot. And he's like, so I wrote the patent for it that day and submitted it. And a couple of years ago, he got a call from the patent office saying it was approved. And so then he decided to build out the technology for the drone, got that up and running, and now he's got the prototype. And now he's doing the demos for DoD. And so you can see that, and nobody wants to invest in these companies at the earliest stage because it's a big risk. Like, how do you know if they're going to be successful or not? That's where you need to look at the people, the patents, their experience, the market, and see if it's a good one. But, it's, to your question, I mean, trends are showing that there's no small spot for this. This is filling a huge void in the marketplace. And the future is just going to be super exciting.
Yeah, that's really interesting. All the different opportunities that you kind of just outlined there. Fascinating to see who's doing what and who's building. I'm curious, just from a structure perspective, going from a regulation A versus a Reg CF cost, why choose one over another? I think you mentioned earlier that you have a good number of Regulation A funds that participate in. I'm just curious, kind of the differences. Why do one versus another, just from the audience's perspective, and what the cost would, at a high level, if you have those numbers, what that would look like potentially.
I'm finding that a lot of the Reg A offerings are done by funds, mainly real estate funds, because they can raise one after the other after other.
Right.
And that's just a big marketplace. It really works best if you can do something like that, because you can just replicate the documents. The SEC's seen it, probably have the investor base, and you can raise, subsequent rounds. That being said, I'm sure there's plenty of companies that are raising $10 million through Reg A. So we're seeing that too. The Reg CF is really for your smaller companies. I would say they have revenues, between $1 and $5 million. It's that sort of pre-A round of financing. Because a solid A is $3 to $5 million. And what we're finding is crowdfunding is it's not just money, it's the community part, because you're going from individual. Venture capital is sort of passive capital. They expect you to do what you say you're going to do. But this middle ground is now about pulling in a group of investors that are active investors. So it's sort of weird, because the transition goes from individual to active group of people to passive investment. And it's how you incorporate that active group of investors through like 2 or 3 rounds, Reg CF rounds. And so you're going to do a few of these. We see, 7 or 8. One company did 9 rounds through Reg CF before they stepped out of it. But I would say you're seeing about 20% of the data set has done more than one offering online. And they're raising small amounts of money. They're doing it sort of back to back, but they're showing milestones to their investors, and they're using their investors to actually help them achieve those milestones. And again, it's going to cost you, depending on how much you're going to raise. If it's $100,000, 5,600, probably. But the more you raise, the more it's going to cost. And then, of course, you have to pay the success fee to the platform.
Right. Very cool.
I don't necessarily want to plug other companies when I say this, but I'll ask it anyway. So, where could people go to, to kind of get involved in crowdfunding? If I, just like the, some of the stories you're throwing out here with, some of these interesting companies, kind of makes me want to just, throw a couple darts out there. Some companies I find interesting. I mean, where could I go to, kind of engage with some of these companies and make investments?
I mean, I tell people all the time, if you want to use crowdfunding, go to the platforms first and search for companies that are in your industry. So if you're in software, I would tell you, go to WeFunder, go to Republic, go to Start Engine. And they've got filters at the top, and you just type software companies, and I'll give you a whole list of them. So you can see, who they are, what they've done, how much they've raised. And then I would tell you to study the successful companies, to see what is similar between all of them, and maybe look at the ones that failed and say, what's the difference between those? And then focus your offering on copying what success looks like. Literally, I mean, I think a lot, there's so much in terms of information that's out there. Of course, you can be 2 different software companies. You can't copy everything. I'm telling you to copy the structure of what success looks like. Mimic that. And I think that'll work. On the debt side, if you go to Honeycomb or SMBX, I think those are 2 excellent platforms where you can see entrepreneurs all over. I think what makes one of them is focusing on different cities. So there's like Crowdfund Baltimore. I think I don't remember which platform that's under, but they work with a city, and they're like, we want to help promote entrepreneurship in your city through debt financing. And they partner with the city to actually put these, offerings together. And then I think the city covers the fees in some of these cases. So it works out well.
Very cool. Sherwood, anything we left out here? Anything else that you're thinking about that might be interesting?
My big thing is we need the media to get involved. It's very frustrating that the only thing that the media likes to cover is fear, anxiety, horror. you know, there's so many wonderful stories within this realm of success, partnership, community getting together and building wealth, intergenerational wealth that's coming from this. And I would love to see more of the traditional media focused on these type of stories because it'll not just only bring awareness to the industry, but it'll bring more capital in. And I really just want to see the institutional capital get in. I think right now, by the way, you've got all these platforms, that are building this, side of the marketplace. It's $2.5 billion now. Okay. We passed the first billion. It took 5 years to get to the first billion, took 18 months to get to the second billion. This year will probably be at 750 million, I think. I'm really gunning for the year that we can hit $1 billion in 1 year. But when you start talking those figures, you got to think someone at JP Morgan has got to begin the conversation of, okay, at what point do we acquire these platforms? Because this is our market. Like we own this, not you. You might have gotten it started, but we own it. And, we will get there. It's a matter of time. But I think that, the conversations need to start happening where they're looking at this from, okay, we see what they did. By the way, there was one instance of fraud in this whole industry. So you do all these Reg D offerings, there's fraud everywhere. Okay. So why don't we stick with the area where there's no fraud? And focus our attention on that. That's why I think, we need to have more media engaged on it. We need to have the institutional capital focused on it. And I think if we get those two things done, this industry is going to be even far beyond what I've even envisioned.
Yeah, very exciting. Yeah, this is very insightful, Woody. Great conversation here.
Good.
Yeah.
Appreciate it.
Yeah. This has been a lot of fun. I've learned a lot. Definitely some good nuggets, takeaways. Woody, where could people go to connect with you and learn more about CCA?
All right. Well, as I said, CCA sits at three themes. So you can go to crowdfundcapitaladvisors.com and just learn about our consulting advisory services and what we do on that level. But if you want the data, our data sister company is called CClear, CCLEAR, and the website's cclear.ai. We have reports for investors, for entrepreneurs. So we've got a weekly tear sheet there that just shows you what happened in week to week. We've got a bi-weekly report that digs in a little deeper. That monthly report that I was telling you about that digs into an industry sector. So you can see what's happening there. It shows you the top 15 companies in that industry. We've got this capital pulse. So we took the algorithm that we did and we've repurposed that for this report that shows you what's scoring high in our algorithm. So if people just want access to that, they can see from our brain trust what we think are companies that are worthy of diligence. And so if you go to shop.cclear.ai, you can see all those reports there. And then guard the liquidity side of the industry is just guardd.com. And that's really, for the blue sky people that, want to figure out how I can get liquidity and secondary trading going.
That's great. We'll make sure to include all that in the show notes of the episode. Amazing.
Great.
Yeah. It's awesome. Thanks so much, Woody.